If you could just focus on Europe a little, there's been a lot of concern with the eurozone in terms of the sovereign debt crisis. How long do you believe it's going to be before Europe can actually put all these troubles behind it and actually get on?
Well, they've got several different troubles. Right now, all of the countries are focusing on reducing their fiscal deficits. And to do that, they're raising taxes and cutting spending. And while that may be necessary in the long run, they're pursuing it in a very aggressive way at a time when their economies are weak. And we're already seeing, even in the case of Britain, a negative GDP quarter. We may see more of those. So I think that quite apart from their banking problems, quite apart from the problems affecting countries like Greece, just across the board, there is a risk of excessive tightening. Moreover, Europe is very heavily unionized. And the importance of that is that when there is inflationary pressure, even if it comes from something like oil and food, there's a tendency for the unions to want to raise wages to compensate for that. And so the head of the European Central Bank has made it clear that he's not going to tolerate higher inflation. Therefore, he's going to raise interest rates to prevent that inflation. So that also will slow down the European economies. So quite apart from these more fundamental problems, we're going to see a further slowing in economic activity in most of the countries of Europe.
Sure. So in that light, would you say that, the whole concept of the eurozone, the creation of the euro as a single currency, was in hindsight only just a great experiment that may not ultimately work?
I think it was a great mistake. Whether it works, meaning survives, is different from whether it works well, meaning helps the European economies. I think it's already demonstrated that it has hurt many of the European economies. It has helped Germany because it has allowed Germany to be a big exporter. It has stopped Germany's neighbors from devaluing their currencies to compete. And so, from a German point of view, it's been a success. But as you look around the rest of Europe, I think it's been a mistake, producing higher unemployment and producing financial crises and banking crises.
So do you believe then that the eurozone actually maybe could fall apart and that countries may ultimately decide to go back to the way they did business pre 99?
It could eventually, but in the near term, even if it would be a good idea for many countries to leave, I think we're going to see Germany paying the price to induce them to stay in, to allow them to default on their debts, to stretch out their debts, to get aid. I think the German business community sees keeping everybody in as important, because if they start to let some out, if Greece leaves or Ireland leaves, which might be fine for Greece and Ireland, that will tempt others to leave as well. Germany doesn't want that to happen, and I think for the foreseeable future, they will pay the price to keep them together.
Now, despite all of the problems within the eurozone, there are many who actually, an increasing number of people who begin to argue that maybe the euro should replace the US dollar as the world's principal reserve currency. Would you agree?
I think the whole idea of a reserve currency doesn't make a lot of sense anymore. When we had fixed exchange rates, you had to have reserves. Every country had to have reserves to deal with the gaps between imports and exports that would arise from time to time. That remains true even with floating exchange rates. But when you look around the world now, you see countries, India, Korea, Taiwan, and certainly China, that have enormous amounts of foreign exchange, much more than you need as reserves in this traditional sense. So the real issue is, how do countries manage their foreign reserves? India has made it clear, has been more transparent than others in saying you want to diversify away from the dollar, not have all of your eggs in the dollar basket, put more of it into the euro. That makes good sense to me. and you've moved more rapidly in doing that than other countries. But we're seeing it everywhere. When I go around and I talk to monetary authorities or sovereign wealth funds, they're realizing that they don't need $300 billion of short-term U.S. Treasury bills as a reserve, that what they really have is a big investment fund, and they have to ask what currencies, what asset classes do they want to invest it in. So I think the issue of reserve is really not what we're looking at. We're looking at how do countries invest their foreign exchange.
Now, if you just look at the US, last year there were a number of people who said that the US will have to come to terms with a jobless recovery, even if it is only anemic. Today, you've got a number of people saying that the US cannot hope for a jobless recovery, given that it is such a huge consumption-oriented economy, that the jobs will have to come back if the US must see any sort of meaningful recovery. Which side of the argument would you be on?
I wouldn't have put it that way. I would say jobs will come back slowly in the U.S. for reasons that I can spell out, but that the growth on the product side will come first, and it will gradually pull employment with it. But we not only have a high unemployment rate, almost 9%, but half of those people have been out of work for 6 months or longer. That's very unusual for us. There are many more people who are on short time involuntarily, so they're working 3 days a week or 4 days a week. So before the unemployment rate comes down, before some of the unemployed get jobs, those people who are involuntarily on part-time work, their employers are likely to move them to full-time work. So I think we're going to see this unemployment rate coming down very slowly. But I think it will come down. We have a well-functioning labor market, and as demand picks up, as production picks up, over the years ahead, we will see the employment situation strengthen, but it's not going to happen overnight.
Do you believe the US needs another round of QE, a QE3, as some people are beginning to suggest?
I don't think we're going to see a QE3. I think QE2 was a bit of a dangerous gamble. Gamble in the sense that it produced a further bubble. Long-term real interest rates in the U.S. are abnormally, I would say, unsustainably low. So bond prices have been pushed up. Maybe the stock market has been pushed up by the low returns that you can get on bonds. Agricultural land, the gap between high quality and low quality debt, all of those bubble-like characteristics, I think, have been made worse by QE2. So I don't think we're going to see the Fed taking the risk of a QE3 unless the economy really falls apart in the U.S.
Now, financial innovation, if we look at it from a markets point of view, they've helped create trillion-dollar global markets across the world. There is some amount of concern now that government is intervening, and government over-regulation could in some manner lead to these markets getting choked. So what would you say is the right balance in terms of rightly regulating a market and wrongly or maybe over-regulating a market?
I think you say it very well. It's a question of getting the balance right. I think leading up to the financial crisis, in the U.S. anyway, but I think this was also true of the European supervisors, regulators, they didn't do a very good job of assessing the quality of the assets on the bank's balance sheets, assessing the amount of capital that the banks had. And so they allowed these very highly leveraged investments by the banks and by others to be made based on misperceptions of risk. And when people realized that so many of these assets were riskier, that led to a collapse in their value. So we need, it's not even so much regulation as it is much more focused and careful and appropriate supervision of the financial institutions.
Now, we've often seen governments incentivizing a risk in politically sensitive sectors such as maybe financial services and real estate, where the losses are socialized, the profits really go to these companies. Somewhere when when governments act in a manner such as that, aren't they incentivizing, in a sense, market players to go back into those markets and take risks that the government just doesn't want really?
Well, I think what you're describing, at least in the U.S. context, is the two big government-sponsored enterprises, Fannie Mae and Freddie Mac, which still dominate the mortgage market. And until recently, they had this very strange structure in which they were privately owned, they were shareholder owned, but they had government guarantees. Not official, formal government guarantees, but de facto guarantees. And indeed, when they collapsed, the government took them over and made good on those guarantees. So while the shareholders ultimately lost money, along the way they had made a great deal of money because of this very strange structure. And fortunately, there is now serious consideration in the United States about moving away from this, about gradually, or maybe not even so gradually, eliminating the special role of these two institutions and putting mortgage lending back where it used to be and where it belongs, which is in the private sector.